Again, I'm Cal Kent, and somebody asked me, when you become a professor emeritus, what does that mean? Well, I don't know what it meant for Tom when he left WVU, but at Marshall, it means they give you a parking pass that says you can park anywhere, anytime, except for athletic events. And so I'm not sure what value that particular item happens to have. The other thing to point out is the joke from Harry Truman was that he got mad and said he wanted to, he was annoyed about economists always saying on one hand and then on the other hand, and I am here before you today as a one-handed economist, and I apologize for that as well. What I want to do is go over the suggestions and proposals that came out of Governor Manchin's Tax Modernization Project. And the thing that will surprise you is to find how closely these mirror the ones of the Governor Underwood's group, even though it was basically a different group of people working under a different set of objectives. If I can get this to work. The goals that were given to us by Governor Manchin is that we were to do a systematic research and analysis of state and local taxation, resulting in the creation of a more equitable and improved tax structure which encourages economic growth. As you notice, this term economic growth has appeared throughout all of those studies that have been done, including the Underwood study. One of the differences was this report, the Tax Modernization Report, said there are things that can be done immediately, and then there are things that need additional study. So as I go through this, we'll break those down by what I've called the short term and the long term. And we'll begin with the personal income tax. The personal income tax, as you all know, is based on the federal personal income tax adjusted gross income. That means there are very few exemptions and deductions. And the only fear that is there is if the federal government makes any major changes in the federal tax code, how is this going to impact the state? Because those will automatically become changes in the state tax code as well. And this has already been found in several instances, so far particularly as the corporate income tax is concerned. And then the next point that we made about the personal income tax is that our rates are not out of line on personal income. But at the same time, because we do not provide the deductions and credits that the federal government has, our income tax is less progressive than income taxes in other states which use the same rates, which do allow for various exemptions and deductions, which we do not have in this state. So what were our short-term recommendations? Well, the first thing we recommended, even though we recognized it would be quite expensive, was a family tax credit based on family size and poverty status. This would phase out as a family's adjusted gross income. We did not want to go away from the broader adjusted gross income, the federal base, but we said there needed to be a family credit that was there. But the one that we proposed would have required an additional 20 to 24 million. And the reason I point this out is, as was the same case with Governor Underwood's project, and that is we feel that whatever is done has to be revenue neutral. That if you make changes one place, you're going to have to compensate for those somehow in someplace else, that you can't just make changes and assume that somehow those changes are going to be offset automatically or by magic or by, and I think back in the 1980s it was magic that we assumed that was going to take care of all of the problems. And then the other thing was that we said we should increase the personal income tax credit. This is part of the property tax relief system that we have in West Virginia, that we said it should be increased to $20,000 of assessed value which of course, since we assess only at 60% of market, that's an additional $33,000 of market value for seniors and disabled. This does not reduce local property tax income because it is a credit that would be taken on individuals' personal income tax and would be a refundable tax credit for those who did not have a large enough tax liability to use it all. And then we also said that there needs to be a significant increase in compliance on withholding for non-residents on income that is earned in West Virginia. There's just a lot of potential income that is actually owed to the state that we really do not get because of our withholding system. There are other states that have better systems. This is particularly true for things like interest, dividends, and of course royalties. And then we also recommended to eliminate the rehab residential building investment credit. The main reason for that recommendation is twofold. Number one, it didn't make sense, and number two, almost nobody took advantage of it, so it really was just another complication in the tax code that was not being productive or necessary. Personal income tax for future study, we felt that maybe we needed to reduce the number of brackets. We also felt that we needed to reduce or completely eliminate the marriage tax penalty, which of course has happened at the federal level. We do want to encourage marriage in this state, I understand, and having been married for 52 years to the same woman, I'm all in favor of that. We also said that there needed to be equal treatment for public and private pensions because some pensions get better tax treatment than others, and this violates at least 2 or 3 of those canons of taxation that we talked about before. And then we said we needed to have better mechanisms to ensure that the taxable income received by non-residents is actually collected. Again, we felt, and there was information given to us that indicated that there is money being left on the table because we simply do not go after and get the taxable income that is earned in West Virginia that by non-residents that we ought to be able to collect, and that there are other state systems, which we can talk about later, that do a better job. So those were our future study recommendations. So far as business taxes were concerned, we found that despite the elimination of the business franchise tax and reductions in the corporate tax rate, business taxes in total, now we're talking about all business taxes, and sometimes people just say, well, just look at this business tax, that business tax. You want to look at the total tax burden on businesses, that they do remain higher than those in surrounding states, and they are above the national average. And there's a report using 2013 data that was just released. I think it was by the Tax Foundation. I think it was last week, which continues to confirm that if you look at our total business tax bill, that we are above average, and also for surrounding states. Well, what were the goals? Well, first of all, we said we needed in business taxes to reduce the burden on capital formation and job creation, particularly in the area of property taxes, and I'll say more about this. You have the situation if someone goes out, brings in new equipment, modernizes their plant, they are rewarded with a significant increase in their property tax bill. On the other hand, if they continue to not replace their equipment, to continue to be inefficient in production, then they get the very significant depreciation, and as a result of that, there's an actual penalty for plant modernization and upkeep in the state. And then we said there needs to eliminate certain tax loopholes and credits. And again, I would stress, you heard the long list, and it wasn't even exhaustive, that Mark Morton had. Many of those we feel are not effective, or we found not to be effective, and we would be better off with a few that really make a difference than all of these small ones that make the tax system much more complicated and much more difficult to enforce, that really aren't doing that much for the state as a whole or its economic growth and development. Then what are our short-run recommendations? Adopt the throwback rule, which would have profits earned in West Virginia but not taxed in other states, taxable in this state, and I think you're in agreement.
Speak for yourself.
It speaks for yourself. I like the throwback rule, and so did our commission. And then the other thing is that we said we needed to counter tax avoidance for passive investment companies by a creation of royalty expenses, intangible licensing, and trademark expenses, that there are ways now that corporations, by creating fictitious dummy entities, are able to really reduce their corporate income taxes by the way that they are able to transfer royalties and licensing and trademarks and others to these other entities which are out of state. Then we said there needed to be the enhanced ability to tax capital gains resulting from the sale of corporate subsidies and subsidiaries, And this simply meant that right now that you don't pay the capital gains tax if you sell off one of your subsidiaries, which we felt did create a problem so far as loss of revenue to the state. And then, of course, the filing of consolidated corporate net income tax returns is something that's been done, and that's been a huge step forward, and I can thank my friend to the right for having led that fight. Alternatives to the corporate income tax, we looked at these. One of them that has been adopted in Ohio is their commercial activities tax, which they established at a rate of a little more than 0.25%. Texas has a similar law, as does Delaware also has a similar law, but this is very similar to our old B&O tax, which most folks, and I think most folks still today, think was not the best possible sort of tax to have. We repealed it in '87, as you noted. But of course, local governments, despite all of its defects, faults, problems, etc., local governments are still allowed to use it, and for many local governments, it is their primary source of revenue. We also felt that the corporate income tax, that we needed to have more exemptions for small businesses to encourage the smaller businesses in the state. We did not recommend this. We did not recommend the Ohio system or the one in Texas for the simple reason that they do pyramid. It means that you pay taxes again and again and again on the same income, and while you can get a lot of income at a low rate, it simply means that you are overtaxing the same transaction as it moves through the production and distribution. And also, we felt that it would make us an outlier among the states, which might make it difficult, which would probably make it difficult for interstate tax cooperation. The other thing that we did look at, which was recommended, and you heard Mike talk about it a little bit earlier, was the single business tax. It's used in New Hampshire as a business enterprise tax. I think it would behoove this committee to bring someone in from New Hampshire. Daphne is one that comes to mind, Daphne Kenyon, to talk about it, because they do use it and have used it very successfully in New Hampshire. But we did not recommend it as an immediate change. We saw this as a long-term tax study to determine whether or not this would work in West Virginia. Some of us like it. It illuminates most of the loopholes. It's a very, very broad-based tax, and I think our recommendation back with the governor was 2%, and that would be able to eliminate almost all other taxes and have a very low tax rate, a very high tax base. We didn't recommend it at this time, but we did recommend it for future study and consideration. Severance taxes. Tax Modernization Project, we had no short-term recommendations for changes in the severance taxes on coal, natural gas, and timber. We did recommend study of them because at the time this report was being done, we were just beginning to see the gas boom that was taking place in the state. And of course, there have been dramatic changes in both coal and in natural gas since 26. And this is something that bears taking a look again to see if indeed our severance taxes are online. I should say that the last point is that considering the combined severance taxes on coal and natural gas, we are among, if not the highest in the nation. And if you really want to have trouble going to sleep at night, you can read my latest book, which just came out last week, entitled Ad valorem Taxation of Mineral Interests, which goes into how mineral interests are taxed in the 10 major mineral producing states. And at least among those 10 major states, which account for the majority of the severance tax revenue, we do have the highest taxes, looking at both severance, corporate income taxes, as well as local property taxes. So this is something I think we need to keep in mind. Okay, let me see if I can move this along. Healthcare providers tax, half of the states have them. It's used exclusively to match federal funds. I haven't seen a recent figure, but I think they've brought in a little over 180 million. Would that be about right if Mark's here? But it's used only to bring in the federal funds. We said that we should not repeal it unless we could come up with an alternate source of revenue. Business tax credits, we eliminated 13 of them in 2002. We replaced these with 3 others. We found little evidence that most of these are effective. And so you can see the ones that we specifically, and this I'm sure is controversial, recommended repeal: the capital company tax credit, the economic opportunity tax credit, the natural gas jobs industrial retention tax credit, along with the B&O tax on gas storage. All of these we eliminated, and the reasons for that are in the report. Consumer sales and excise tax, needed to point out that the repeal of the tax on food, it was one of those ideas that sounded great. It cost us about 14% of our sales tax collections. It was not recommended by either of the 2 studies, nor by any other study, but it happened anyway. We also felt that there was a need to change the direct use and manufacturing exemption. Now, if you buy products and inputs and you use them directly by the manufacturer, you get the credit. But if you are working through a contractor rather than doing it yourself, the contractor does not get the credit. And so we felt that the contractors ought to get the credit in the same way that the manufacturers get it directly. And then we were very much in favor of increased taxes on cigarettes and tobacco products. We are below surrounding states. I'm not going to get into the health argument because we did not get into the health argument, but it is simply to note the fact that these are products which we do not have a tax burden that is nearly as high as our surrounding states. And as a result of that, we don't have to worry about the perennial problem that's always brought up of butt-legging. Okay, property taxes and local government finance, and to the extent that I have an expertise in this area, just so that you know, I am a certified assessor. I also am on the executive committee for the International Association of Assessing Officers, and I'm just in the process of doing a major project for the state of Georgia, have another one coming up for the state of North Carolina. So I do a lot of work outside of West Virginia, as well as serving on the West Virginia Property Valuation Commission. Our goals were to improve assessment and collection of property taxes and municipal fees, as well as providing the greater flexibility, completely consistent with what was said by Governor Underwood's group. While property taxes on owner-occupied homes are among the lowest, if not the lowest, in the nation, and I've just seen figures that said, well, we're not quite the lowest. There's one state that is lower than we are, and others say that. But if you consider particularly property taxes on owner-occupied homes by individuals who are disabled or aged, we do have very low property taxes. And the other day, I was teaching a course for the state tax department here on property taxation, and I was drinking my favorite legal beverage, and the person asked me, who was waiting on me, well, what are you doing? I said I was teaching a course, and she says, well, on property taxation, and she jumped up and she said, I want you to tell those SOBs to lower that tax on me and lower it next session. So people around here don't believe it when you tell them that we really do have a good deal. And you got to remember that on owner-occupied, not on rental property, which is a problem for low-income people, by and large, who are renters, they pay indirectly through the rents they pay a tax that the property tax, which is twice as high. And the reason, though, and let me do the next one, because the one thing that we found more than anything else in the property tax area that we needed to do was to eliminate the tax on inventories or reduce or eliminate the property taxes on machinery, equipment, and fixtures, because this is where we are out of line with other states. Now, again, for a lot of businesses, this isn't going to make any difference. But if you want to have businesses that have to carry inventory, have to produce inventory. We do have, of course, for products that are in transit, we don't tax the inventory, the Freeport legislation as it's called. But our situation now is that most of our surrounding states don't tax inventories, and they don't, if they tax equipment and fixtures, they're going to do it at a much lower ratio. And as I said before, we felt this was necessary if you really wanted businesses in the state to update their equipment and to bring new equipment into the state, that you didn't reward them with a penalty of the property tax, of a higher property tax. And then, of course, the biggest problem with doing that, and this is what stopped the recommendation cold in its tracks, is you've got to find a replacement source of revenue. One of the problems statewide that we have had in the past is where the state has passed exemptions, deductions, modifications, whatever you want to call them, to the local property tax, and then have left the local property, the local jurisdictions, to pick up the tax bill. And that has, particularly for counties, put everyone in local governments in a real bind. So if you are going to take away the local tax base, they have to have a replacement source of revenue. And Ken Sowards is with me, and he'll want to make a couple of comments about how any tax reform at the state level feeds back into the local level, particularly local school finance, because again, everything is related. You've got these unintended consequences, and your problem simply is, if you start making large exemptions in the property tax, then where does that leave you with your school finance? And with school finance, under the legislation, as Kent will mention in just a moment, that increases your burden on the state. What are the short-run things? Well, first of all, sheriffs and city finance officers are not privileged in this state to access property tax information. See no reason for that, but we're one of the few states that don't allow sheriffs and city finance officers, who are the ones that have to collect it, to have access to the property tax records that are there. Second was to permit the state tax department to enter into agreements with local governments to exchange information, including federal employee tax identification numbers, to aid in the collection of taxes and fees. If the cities are to continue to use the B&O tax, this is one of the most effective ways that we could improve on the enforcement of that tax, of the B&O tax at the local level. Because right now you can't get that information. The state has privacy provisions that are in code, I would add, and if you really want to make that tax effective, if you want to eliminate the avoidance, which is rampant at the local level, it's really a tax on honesty, the B&O tax is, this is something that needs to be done. Then the next problem was with the collection of delinquencies. If taxes are delinquent in this state, the county has to pay the full cost of collecting the taxes. Those delinquent taxes go primarily to the schools, and also to a lesser degree to the cities. It was our strong feeling that the governments that profit from the collection of delinquent taxes should be the ones that should share in the cost of collecting those taxes as well. And then the last thing was the municipal liens on property for uncollected fees should be allowed, and these should be given the same priority as county property taxes are. Because right now these liens, when they are levied, are so far down the list that you almost never, at least our experience has been, that local governments almost never are able to collect them. Again, in the short run, here is one that is a huge problem in the state. We tend to ignore it, and that is exemptions for charitable, educational, religious, and other property. The law is unclear. The court decisions have made it less clear. We found in our studies that there is no consistency among the 55 counties as to what is considered to be charitable, educational, and exempt. And I don't know if Dale Steiger's still here or not, but if he is, he certainly is familiar with this issue. And then the other thing and this is really something that just needs to be done in terms of fairness. Why should the Blue Goose Lodge in one county be exempted and fully taxed in the next county is a mystery. And the county people want this, the assessors want this, and yet nothing has happened. And again, if you want to be bored, I've got a major law review article out on this topic as well. Okay, revisit the definition of a farm for farm valuation. The current threshold is you only have to have $1,000 in income. If it's less than 5 acres, only $500 in income. And the result of this is, these very, very low thresholds, is that we have a number of very small tracts that are being taxed under use provisions that are just bordering cities, waiting for the market to catch up, and in some cases we found that these small tracts were selling for as much as 600 times their use valuation when they finally went on the market. And then the other thing that we mentioned, that the owners of severed mineral interests, and this is about 90% of your mineral interests in the state of West Virginia, have been severed from the surface ownership. They should be paid by the operator on behalf of the owner. This is how it's done in the majority of states, and that is the owner collects it for the royalty holder. In our state, we send out stacks of small little tax tickets, mostly to out-of-state owners. Maybe it's for 1/100%. A lot of those never get paid. In fact, it costs more to send out the notice than you're going to bring in taxes. And so here's a way to rather significantly increase your income by having the owner pay it. My wife is an interest, 1/100th interest in a gas field that she inherited in Louisiana. Her operator just deducts their taxes from the royalty that she receives, and they get all the money that way. And for the life of me, I don't see why we do it the way we do it here in West Virginia. And we do lose a lot of money as well as complicating the system. What should we study? Change the Constitution to allow local governments to pass general obligation bonds with 50% majority. School districts can now do it, but local governments to have a 60% in order to pass general obligation bonds. Right now, we are not allowed to report delinquent taxes and fees to credit reporting agencies. Again, something other states do. It's been demonstrated that this is a real way to get people to start paying their past due taxes if they know that Equifax and Equifax's similarities are going to get that information and it's going to be reflected on their credit score. Study the taxation of voice over internet protocol. Then we recommended strongly, because the government that is being abused or hamstrung the most is county government. County government right now has almost no taxable flexibility, and you've got the regional jails, which was a state mandated program with no revenue sources to pay for it, that we felt that county government should be allowed to levy sales and user taxes if they wanted to. This would have been an option. Then establish a state board for appeals of property valuations on minerals and industrial property. We've taken a major step already in business property, but what we are saying is most states have a separate board that deals with these valuation issues, particularly on minerals and industrial property, and makes the final decisions there. Since minerals and industrial property are state assessed, that it should be a state board that makes the decisions on appeals for those assessments. And then the other thing to consider is whether we would have a recapture provision on taxes when a property's valuation changes from use to market. A lot of states say if we're going to continue to tax it as use, that's fine, but when that use is over, we ought to be able to go back and collect a few years back taxes, and that would encourage this property to be put into use much quicker. And that is the end of the presentation. That's a summary.
I think a lot of the recommendations that came out of the Tax Modernization Project, which I had a decent role with, but also the Governor Underwood's Fair Commission, of which I got to do a lot of the data work. We have to take care and we have to study, because those ramifications aren't that simple. You pull one lever and it has an anticipated effect, but those unintended consequences are never as small as we hope they would be. You look at the PSSP, which is the school support program in West Virginia. When you make changes to the property tax, even if they might be minute, that could have large ramifications in the general fund expenditures that's incumbent on the state to fund local schools. And really quickly, I'll make a couple other points and then duck out, because batting at the bottom of the order after Mr. Morton, Mr. Muco, Mr. Carl, and Dr. Kent, there's not a lot left for me to say. But if you look at the history of our tax system, which Mr. Muco went through in some detail this morning, and we'll have a little bit more, a lot of times we were making changes to catch up to the changes we had made prior. And the last thing that I really want to touch on is another concept that appeared in several of the studies that we've done thus far, and that is trying to find local flexibility, or providing more options for municipalities and counties, in which Dr. Kent mentioned the counties have very little flexibility. The problem with this is that there's also very little of a base in some counties, so you can give them a good deal of flexibility, but the options of what they have available and what can actually generate the revenues necessary to provide those services that their constituents expect are necessarily small. So changes, again, at the state level have a large ramification for individual municipalities and counties.